Hello friends, I am Ram. In this video, we are going to discuss how we can save around 50 lakhs taxes from our retirement withdrawals. I am going to explain this with Mr. Sharath case study. He is an NRA. I'll give a little background about him quickly and then compare to case study. Okay, so Sharath did his MS in USA. After that, he worked few years there and then he started his own consulting firm. So now he and his wife working in his consulting firm. In US they worked around 15 years. Now they are in 30s. They want to come back to India because they vexed up with work in USA and they want to come back in India. When they check their net worth and cash flows, they realize that they do not have any cash flows generating assets because they are having around 10 CR net worth, a couple of homes in USA, and especially in India they are having only plots, so they are not generating any cash flows. So when they come back to India, they don't have any cash flow generating assets. So they decided to build some liquid portfolio in India. So they approached us 1 year back. So we started mutual fund investments for them. So around 1 CR investments they already did, and other equity investments also they are doing. So till date in the last 1 year they did around 2 CR investments and equity related investments. So now what they decided is they want to invest for next 4 years 2 CR each, wife and husband 2 CR each. They want to invest in NRE fixed deposits. A rationale behind it is NRE fixed deposits are tax free, so they want to invest for next 4 years in NRE fixed deposits. Once they move to India, they'll convert them into regular fixed deposit. Then they have to pay tax on it. So after this discussion, we checked any other fixed income equivalent instruments we can invest so that we can reduce the taxes which they are going to pay on regular fixed deposits, because taxes on fixed deposits are very high as per our tax bracket. So we narrowed down to debt mutual funds. They are equivalent to fixed deposits. They are like liquid funds or corporate bonds. They most likely give kind of fixed deposit returns. Also, they are very secure and stable. Now we will discuss both the scenarios. One scenario is fixed deposit. If we invest that 2 CR amount in the fixed deposit, what would be the taxes and what would be the after tax returns on it? And other scenarios, if we invest in debt mutual funds, what would be the taxes on them and what would be the after tax returns on them? So we are going to see these two scenarios in the Excel now. I am going to explain you both the scenarios. So assuming that 2 CR which we are investing for husband now, and then I'll calculate other person as well for both wife and husband as well. So assuming that we are now investing in fixed deposits 2 CR. To explain it in a simple way, I am assuming that this 2 CR investing in the beginning itself instead of accumulating over a next 4 years period. So I have taken this 2 CR here. Fixed deposit interest rate currently around 6.5 NRE fixed deposits. Okay, if I add this 6.5 here, so you can observe here next 4 years it is getting accumulated and you won't see any tax for the next 4 years because NRE fixed deposits are tax free for NRIs in India. Okay, so here you can observe up to next 4 years it will get accumulated with this 6.5% interest rate and it will become 2.4 CR. So from 2030 onwards, Sharath will take entire interest as a withdrawal because they are going to use it for their expenditure and the world tour they are going to plan for that. Okay, so from 5th year onwards 15 lakh 70,000 Mr. Sharath going to withdraw. Okay, how much tax would be levied on it? So it would be around 1 lakh 15,000 tax would be levied on 15 lakhs as per the progressive taxation and on these slabs. Okay, so now I am going to calculate after tax withdrawals. After tax amount would be like this. Same amount will continue because same amount you are going to withdraw for next 21 years. I have kept this table for 25 years. First 4 years the accumulation period and next 21 years are the withdrawal period. So these will be the after tax amounts. Now what I am going to do is I will calculate. I have done these calculations for one person. Wife and husband both are going to invest 2 CR, right? So I am going to calculate for wife and husband how much would be withdrawal, how much would be tax, and how much would be after tax withdrawal. So I have copied formulas here. For this period, this would be the amount. These are the before 31 lakhs would be withdrawal for both wife and husband, around 2.3 lakh per annum tax for both wife and husband. I just multiplied with 2, and this is after tax. This one minus this one, you will get this one. Okay. So how much should be effective tax rate? Yeah, total around 48 lakhs they are going to pay for next 21 years on these withdrawals of 6.6 crore. Okay, effective tax rate would be 48 lakhs divided by 6.6 crore, so 7%. So here one thing you need to observe, we already did a kind of tax planning here, because both wife and husband divided their 4 CR accumulation as 2 CR. That's the reason here you are getting a less effective tax rate, because taxable income here is 15 lakhs only up to 15% tax slabs will be applied for that. So if I check this by changing to 4 CR, just one time, this total tax would be on the 4 CR would be how much? 1 CR 9 lakhs. So that is far higher than 48 lakhs on the same 4 CR if we divide to wife and husband. Okay, just let us ignore that. Anyway, we are checking in this way. Okay, so let us do same thing, same calculation in the debt mutual fund now. I am typing here 2 CR and same 6, assuming that same 6.5% return you are getting in the debt mutual fund. So in the debt mutual funds also, if you don't withdraw, whatever amount is accumulating here won't be taxable until you withdraw it. Okay, so I am accumulating here up to 4 years, and after 4 years, so I copied same number here 2.4 here and withdrawing same amount 6.5% on the this amount. So this this amount won't increase, because exactly we are withdrawing 6.5% of the whatever growth is coming from this debt mutual fund as well. So I have also kept other 2 columns, NAV. Mutual fund units are in NAVs, right? So I kept NAV here. I increased NAV with 6.5% every year. Okay, and units, when we calculate units, number of units, 2 CR divided by NAV, we get 20 lakhs. So up to next 4 years, units would be same. After that, units number will decrease because we withdraw some units. Now, what would be how much units we are going to withdraw here? So for first year, we are going to withdraw 15,70,000 withdrawal amount divided by latest NAV 12.86. We are getting 1,22,000 units. So these are the units we are going to withdraw for next 21 years. I'll calculate capital gain now. This is important. Now listen. So capital gain is important here. So how much capital gain we are going to get for the first year? We are going to get around 3,49,000. How we calculate this? 12.86 minus 10. We are getting capital gain per unit 2.86. We multiply with number of units. So I am copying this formula for entire period. So we are getting capital gain like this. Even though units are getting reduced, capital gain is getting increased. Why? So we'll check this. So here unit value increased to 24. Okay. So when we calculate capital gain, we subtract 24 minus 10. We are getting capital gain per unit how much? 14 rupees. We multiply that 14 into 65. So we are getting 9,20,000 in this year capital gain. Okay. Now that is the reason, as NAV value will increase, capital gain will keep on increase. But this capital gain, you can observe, this capital gain will not exceed this taxable amount. Here one thing you need to understand, in debt mutual funds, this withdrawal amount, entire withdrawal amount won't be taxable, only capital gain is taxable. So that is where this tax differentiation would create. Now let us check. This capital gain would be the taxable amount, right? So this taxable amount is less than 12 lakhs until next 19 years. So effective tax rate would be 0 if taxable capital gain in debt funds is less than 12 lakhs. it is taxed in the similar way as FD. Equity mutual fund capital gain would be taxed differently. We will discuss maybe in another session, but debt mutual fund taxation would be same as fixed deposits. So here disproportionately we are getting benefit because until next 19 years you need not pay any tax at all. In the 20 and 21st year, amount is just increased to 12 lakhs. When just increased to 12 lakhs your taxable amount, then you are required to pay tax from 4 lakh onwards. So you are getting around 60 and 63,000 for the last 2 years. Now I will calculate after tax amount. So after tax amount would be almost the same as withdrawal amount, because you are not going to pay any tax for next 19 years. So these 2 years also little bit tax you are going to pay. Now we will calculate for both wife and husband. Now you can check this. Both wife and husband withdrawing almost same amount as withdrawal, which is more than 29 lakhs. In the previous case, FD case 29 lakhs they are withdrawing. In debt mutual fund case 31.4 lakh they are withdrawing. You can see effective tax rate also. Total tax would be for both the spouses after withdrawing 6.6 crore on just 2.5 lakhs. So if I keep it to zero level, if I keep it to one digit rounding off, effective tax rate is 0. Otherwise, it is just 0.38% effective tax rate. So this is how you can actually save lot of tax using debt mutual funds. Now what we will do is we will also incorporate salary component. In this case study, once they move to India, as I said that they are having some consulting firm. Actually then consulting firm employees work based on India only, even though they stay in USA. After they move to India also, they may spend some time with their consulting firm and they take some salary. Assuming that they are taking 12 lakh each salary. So what would be, how much tax would differentiate if I add 12 lakh salary also in this case study. So I have added 12 lakhs in FD case, FD plus salary. In this case, tax is drastically increased to 4 lakhs. Why? Because taxable amount now 27 lakhs. So higher tax brackets will also apply. So these tax brackets also will apply for some amount. So tax amount has got increased. Total tax would be 1.7 CR, total withdrawal and total withdrawal amount of 11.6 CR. So effective tax rate would be 15%. So in case of debt mutual funds plus salary, so if I put the same amount, here also total taxable amount increased to 93 lakhs. Effective tax rate is still better, 8% only. So if I check the difference, in the earlier case difference would be around 45-46 lakhs. In this case still difference is 79 lakhs, which is even higher than earlier 45 lakhs difference. Okay. Yeah, in the both the scenarios, either you take fixed deposit and debt mutual fund scenario, and fixed deposit plus salary and debt mutual fund plus salary scenario. In the both the scenarios, debt mutual fund plus salary, debt mutual fund scenario is a clear winner in our comparison. So this case study or this investment approach may not suitable for all the investors, but whoever are investing, who are already invested a lot of money in fixed deposits and getting interest on them and paying lot of TDS, for them investing in debt mutual funds would be much more meaningful. For the people who are invested a lot of money in fixed deposits and they don't need any withdrawal, but they are still paying TDS on yearly interest amounts. For them, it is the really best option. For very conservative investors also, debt mutual fund option is very, very good option. Hope you like it. Please do subscribe to our channel for this kind of personal finance educational videos. Thank you, friends.